A financial advisor sits across from you and mentions their management fee is just 1%. It sounds completely harmless. 1% feels like a tiny tip for expert guidance. In everyday life, 1% of anything is practically nothing. You smile, sign the paperwork, and walk away feeling confident that 99% of your returns remain safely in your pocket. But 30 years later, when you check your final nest egg, nearly 1/3 of your entire potential wealth is completely gone. This is not bad luck, and you did not make a foolish trade. You stepped directly into a mathematical optical illusion. Your brain looks at 1% and naturally assumes you keep the remaining 99. But money does not work like that. When you buy groceries or leave a tip, a percentage is a one-time transaction. You pay it once and it is over. Investment fees are fundamentally different. That 1% fee is charged every single year, regardless of whether your portfolio makes or loses money. More importantly, that fee is deducted from your entire balance, not just from the profits your investments manage to generate. If the market gains nothing in a rough year, your advisor still takes their 1% cut directly out of your principal. Vanguard founder Jack Bogle called this the tyranny of compounding costs. And it is the most destructive force in personal investing. You already know how compound growth works in your favor. Like a snowball rolling downhill, your interest earns its own interest over time. Negative compounding is that exact same engine running in reverse. Every dollar removed in fees loses its ability to compound forever. To see how quickly this adds up, let us place two identical retirement accounts side by side over a 30-year timeline. Both start with the exact same initial balance. But watch what happens to the gap between them as time starts ticking forward. Imagine you invest $100,000 into a standard market index fund earning an average 7% return every year. Portfolio A pays an ultra-low index fee of 0.05%. Portfolio B pays a 1% advisory fee. At the end of year one, Portfolio A grows to $106,950. Portfolio B reaches $105,950. The difference is exactly $1,000. You look at that $1,000 difference and shrug. To you, paying $1,000 for professional management feels reasonable. And that quiet acceptance is precisely where the illusion takes hold. Because you are only looking at a single snapshot in time. Now, fast forward 10 years down the road. Both of your accounts have benefited from a decade of steady market compound growth. Portfolio A has grown to roughly $195,000. It nearly doubled your original investment. Portfolio B, however, sits at only $178,000. The gap has quietly widened to $17,000. You might assume you paid $10,000 in fees over 10 years. But your account is missing $17,000. Why? Because the advisor did not just take your fee. They took the future compounding power of that money with them. That first $1,000 taken in year one could have compounded for 9 more years, doubling inside your own retirement nest egg. In finance, this invisible drain is called opportunity cost. And it is far larger than the actual dollar fee you paid. Every dollar that leaves your portfolio is a worker permanently removed from your wealth-building army, never able to earn interest again. 10 years created a $17,000 penalty. But what happens when that engine runs for 20 and 30 full years? By year 20, the math begins to accelerate violently. Your initial $100,000 has now spent 2 full decades compounding. Portfolio A, with its tiny 0.05% fee, has now surged to approximately $387,000. Portfolio B reaches $320,000. The cost gap has now ballooned from $17,000 to $67,000. Think about that number for a moment. That $67,000 loss is more than 2/3 of your entire original investment. The gap is no longer growing in a straight line. It is compounding exponentially against you, pulling wealth away faster every single year. Now, you finally reach year 30. You are ready to retire, pack up your office, and live off the fortune you built. In the low-cost index portfolio, your $100,000 has quietly transformed into an astonishing $761,000. In the 1% advisory portfolio, your balance sits at just $574,000. A staggering difference. The gap between these two identical portfolios is now $187,000. Nearly $200,000 completely evaporated. That innocent 1% fee did not take 1% of your wealth. It quietly consumed 25% of your final retirement. That missing $187,000 represents 5 full years of retirement living expenses wiped clean from your future. This is why the financial industry loves percentage fees. To your brain, 1% feels insignificant. To their balance sheet, it is massive. Behind the curtain, the institution takes no market risk with their own money, yet extracts a guaranteed slice of your compounding growth. They get paid in bull markets, they get paid in bear markets, and they harvest the compounding returns your patience created. You might ask, but does paying an advisor beat the market and justify that cost? The historical data reveals an uncomfortable truth. Every year, S&P Dow Jones publishes a comprehensive scorecard called the SPIVA Report, measuring active fund managers against broad market indices. These fund managers are elite professionals with Ivy League degrees, supercomputers, and massive research teams analyzing corporate earnings around the clock. Yet the data reveals that over a 15-year period, more than 90% of actively managed funds fail to beat the index. They fail not because they lack talent, but because the 1% fee creates a mathematical headwind that is virtually impossible to overcome. If the market returns 7%, an active fund charging 1% must generate 8% just to match the market return. Generating that extra outperformance consistently year after year against efficient global markets is something almost no fund manager can sustain long-term. So you take 100% of the market risk, but pay a guaranteed fee for an outcome that historically lags behind. You might wonder, if active funds statistically underperform low-cost index funds, why are they so enthusiastically sold across the entire industry? The answer lies in two legal terms that sound almost identical: the fiduciary standard versus the suitability standard. A fiduciary is legally bound to put your best interests first, recommending the absolute lowest cost, most efficient investments for your specific goals. Under the suitability standard, however, an advisor only has to recommend an investment that is deemed suitable, even if it pays them higher commissions. That means they can lawfully steer your retirement into high-fee mutual funds that quietly kick back revenue directly to their firm. Your advisor may be genuinely friendly, but their company's compensation model is designed to harvest a percentage of your compounding wealth. These costs often hide in your 401k statement under technical labels like expense ratios, administrative charges, and 12b1 marketing fees. So how do you uncover the hidden fees leaking from your own retirement accounts right now? The audit begins with 3 simple numbers. Step 1 is finding the expense ratio of every fund you own. Log into your account and look up each fund ticker symbol. A broad total stock market index fund typically charges around 0.03%, while actively managed mutual funds often charge 20 times more. That means on a $10,000 balance, you pay just $3 a year for an index fund versus $85 for active management. Step 2 is identifying any advisor or advisory wrap fee. This is the management fee charged on top of the underlying fund costs. If your advisor charges 1% and places you into mutual funds charging 0.85%, your total annual drag is nearly 2%. A 2% annual drag does not just slow your progress. Over 30 years, it quietly consumes nearly half of your entire potential wealth. Step 3 is checking your 401k plan administration fees, disclosed in your annual 40405 participant fee disclosure statement. Some generous employers cover these administrative costs entirely, while other plans pass them on to you as flat quarterly deductions or percentage charges. Now that you know how to audit your total fees, what should you do if you still want professional guidance without the percentage penalty? Look for a fee-only fiduciary advisor who charges a transparent flat hourly or project rate, rather than taking a perpetual percentage of your assets. Paying a flat $2,000 fee for a comprehensive financial plan leaves all your future compound growth entirely in your own account. You can verify any advisor legal standing for free using the SEC Investment Advisor Public Disclosure Database and FINRA Broker Check tool. Ask them 3 direct questions. Are you a fiduciary at all times? How exactly do you get paid? And do you receive commissions? If they say fee-based instead of fee-only, that subtle distinction means they can still accept third-party sales commissions and kickbacks. And if you choose to manage your own portfolio, the mathematical solution is even simpler, cheaper, and historically far more effective. For decades, Wall Street convinced you that investing requires complex algorithms, high-priced stock pickers, and constant trading to generate real wealth. Yet the mathematical reality pioneered by Nobel laureates and index innovators shows that owning the entire market beats picking individual stocks. Instead of searching for a needle in a haystack, you simply buy the entire haystack with a single broad market index. A broad total market index fund gives you instant fractional ownership in thousands of profitable businesses across the entire United States economy. Because a computer automatically tracks the index without expensive managers, the annual management fee drops to almost nothing. Just 0.03%. That means 99.97% of every single dollar your investments earn stays directly inside your compounding nest egg. To build a complete, diversified portfolio, many long-term investors rely on a simple framework known as the three-fund portfolio. Fund 1 covers the entire United States stock market, capturing the growth and innovation of domestic corporations across every major industry. Fund 2 adds broad international equities, giving your portfolio global diversification across developed and emerging economies outside your home country. Fund 3 introduces high-grade total bond indices, acting as a financial shock absorber to dampen market volatility as you age. By adjusting the ratio of stocks to bonds over time, your portfolio naturally shifts from aggressive growth toward steady wealth preservation. You never have to guess which individual company will win or lose, because you own all of them at once. When you automate your contributions and reinvest your dividends, compound growth operates at peak efficiency, completely free from advisory fee friction. There are no hidden sales loads, no 12b1 marketing fees, and no financial intermediary skimming 1% off your total balance. But keeping your fees near zero is only half the battle. You also have to protect your portfolio from your own human psychology. Nobel laureates Daniel Kahneman and Amos Tversky proved that the psychological pain of losing money is twice as intense as the joy of winning. When market headlines flash red and stock prices dip, your ancient survival instincts scream at you to sell everything and protect your cash. Panicking during a downturn locks in temporary paper losses as permanent financial damage, turning a normal market fluctuation into a devastating personal disaster. Long-term market research reveals that trying to time market swings is a mathematical trap that destroys more wealth than almost any advisory fee. Over a 20-year period, missing just the 10 best trading days in the market cuts your total compounding returns nearly in half. Here is the critical catch. Those 10 best days almost always occur within 2 weeks of the absolute worst market panic days. If you sell during the panic and wait until the news feels safe again, the massive recovery surge has already passed you by. Selling low and buying back high creates an emotional tax that compounds against your retirement just like an aggressive hidden advisory fee. When you combine high management fees with emotional panic trading, a 30-year portfolio can lose more than 60% of its potential wealth. The most successful strategy is deceptively boring. Build a low-cost diversified portfolio, automate your monthly contributions, and never touch the steering wheel. By automating your investments, you remove human emotion from the equation, ensuring your wealth compounds quietly in the background without psychological sabotage. Every historical crisis, from the dot-com crash to the 2008 recession, eventually gave way to new all-time economic highs. During downturns, your automated monthly deposits buy more shares at discounted prices, accelerating your compounding engine when the market inevitably recovers. When you understand both the arithmetic of low fees and the psychology of patience, financial anxiety transforms into calm, unshakable confidence. Now, let us put all of these pieces together into an actionable 4-step checklist you can implement for your money today. Step 1. Run a complete fee audit on your 401k and IRA. Calculate the exact expense ratio of every fund you own. Aim for broad market index funds with expense ratios below 0.10%, keeping your annual fund drag near zero. Step 2. If you work with an advisor, demand in writing whether they are a fee-only fiduciary at all times. If you need professional advice, choose a fee-only planner who charges flat hourly rates instead of taking a perpetual percentage cut. Step 3. Streamline your investments into a simple, diversified portfolio of broad domestic, international, and bond index funds. Turn on automatic monthly contributions and dividend reinvestment, letting pure compounding do the heavy lifting for your future. Step 4. Make a promise to your future self that you will never panic sell during temporary market downturns. Remember that short-term volatility is simply the price of admission for long-term compounding growth, not a reason to abandon your plan. When you eliminate unnecessary fees and avoid behavioral errors, you reclaim hundreds of thousands of dollars for your family. That reclaimed fortune buys you more than just numbers on a screen. It buys you time, options, and genuine financial independence. The entire wealth management industry relies on the assumption that you will never do the compounding math for yourself. They count on 1% sounding small enough that you shrug, sign the contract, and look the other way. Now you understand how the machine actually works. The real math is on your side, and the power is in your hands. You do not need complicated schemes or expensive gatekeepers to build enduring wealth. You only need low costs, patience, and clarity. So the next time someone sits across from you and mentions a harmless 1% fee, you will see the entire chessboard.